Good evening, students. Welcome to the live coaching classes organized by Board of Studies and CA. Today's topic, today's evening, we will study on this topic called duty drawback and refund under GST, indirect tax, customs law. This topic is very important. Every one of you dealing with direct tax or indirect tax, in the process of finalization of your books, you will find one miscellaneous entry in the business where they do export of consignments. There will be some nominal duty drawback where you will see like some miscellaneous income which will be recorded for that. So any business you see where there is an import and export, this is one chapter which predominantly you will come across. And examination point of view, students, mandatorily 4 marks is the weightage you have from this particular chapter. So before we get on to the discussion, as a protocol, people who are watching, please confirm you are able to listen the audio and also the presentation, PowerPoint presentation is visible. Mansa, I have your question, received your question. No? Mansa is asking a question, master of a vessel and person in charge can be the same person. Generally, the person who is in charge of a vessel, we call him as a master. In case of an aircraft, we call him as a pilot. So these are the people who are in charge for filing export general manifest or import report, IR or IM, import manifest. So both the cases, person in charge is the same gentleman. So thanks for the confirmation, Balaji. So we will continue with our today's topic. Next 3 hours, I'm going to take you through with understanding what do you mean by duty drawback. What circumstances cause one to think about duty drawback? Then what are the nuances or the circumstances under which a drawback is permitted? How we have to deal with the conditions provided under drawback. And in the process examination, you can expect a simple problem, maybe for 3 marks, where they'll ask you computation of maximum duty drawback or minimum duty drawback. Restrictions imposed, what are the conditions for claiming a duty drawback? Then another important topic called refund under customs law. So there is a thin line of difference for drawback, for refund. Technically, my drawback is nothing but refund of duty or taxes paid. But under the customs law, we have a separate chapter which deals with your duty drawback, which also deals with your refund. So I'll make you to understand the provisions which are connected with refund. Okay, there is a big question from Purushottam. Before we continue further, let's just take up the question from Purushottam and then we will go forward. Purushottam is asking this question. Suppose a supplier from China has got consignment from Japan. Goods loaded in the vessel reaches Japan via India. At the customs port of India, consignment goods of Mr. A are unloaded by mistake along with some another consignment. Those goods are kept at bonded warehouse at custody of custodian. After a few days, Mr. A identifies that these goods are customs port in India are for as the custodian to ship to Japan. In this scenario, bonded warehouse are treated as a fixed place of business for determining the location of the supplier in that consignment. If so, it's subject to supply under GST on the view custodian of warehouse satisfied. Okay. Purushottam, I'll make it very simple for you to make understanding. In case if goods are transshipped from India, so generally, though the moment the goods get into customs water, there is the applicability of customs duty. However, the duty needs to be paid only when a bill of entry has been filed. In your question, the goods have entered into India, which have to be transshipped to, say, Japan. So these goods, by mistake, the importer has put into a warehouse. After a point in time, he noticed that this goods have been warehoused and the goods needs to be sent back to Japan. So please keep in mind, Purushottam, unless a bill of entry is filed, the duty does not get crystallized. So what this gentleman will do, he will cause export from the bonded warehouse without payment of any duty. So in this case, custodian is just holding the goods for the purpose of collection of customs duty when the order is passed. If the customs officer, that is a proper officer, permits Mr. A to export from the bonded warehouse, custodian will elect the exporter to take it out of my bonded warehouse. So in this case, no need to pay any customs duty. So Purushottam, hope I have answered your question. From GST point of view, no need to pay any GST. This is covered under Schedule 3. Then Mansa is asking, master of a vessel and person in charge, even in case of warehousing Mansa, please keep in mind, this person in charge generally will be referred to a person who is holding the goods as baggage, the goods which is carried in the vessel or aircraft into the customs station. So generally when they say a person in charge, we refer to this master or pilot. Once the goods reach customs station, Mansa, we don't refer to person in charge, rather we call him as a custodian. There is no person in charge, right? So this term person in charge is only referred in case of import by way of aircraft, vessel or vehicle. This is the way we have to understand. Good evening, Viraj. Good evening, Geeta. Let's continue with our today's discussion. Now, background, I'll make you understand this concept of duty drawback. Very, very interesting topic, I would say, duty drawback and this concept called refund under customs law. Just don't worry with the technicalities, whether you have prior experience of customs or not, but this concepts are very, very simple and easy. Examination, please remember, there's going to be a mandatory question for 4 marks. Maybe a theory, maybe a problem. So theory, they may ask in relation to provisions connected with drawback. Explain the provisions when the importer can claim drawback. Explain the provisions concerned with export of goods after usage, export of goods without usage. So there are general time limits. It's a very simple table which we have. How we will calculate the duty drawback. Or a question can be asked from a topic called unjust enrichment. Concept of unjust enrichment. Quite interesting and easy to make an attempt in your examination. So either provisions connected with duty drawback or concept of unjust enrichment under refund. When unjust enrichment will get attracted, what cases this theory of unjust enrichment is not applicable. As I take you through, I'll make you understand with respect to this concept called unjust enrichment. So first and foremost, let's understand what do you mean by this duty drawback. Please keep in mind, this language is a worldwide language. Duty drawback is not coined per se in India. So the practice where when there is a duty which was paid on the goods which are imported, and I have put to use in India, after a point in time, I have to send it back out of India. So that point in time, the theory or the concept is to evaluate, was there any burden on the importer for the duty which he has paid at the time of entry? In case if there is a burden, how this burden can be eliminated on the occasion of the goods which have been sent out of India. And please keep in mind, these provisions are not applicable even for baggage provisions. So what I'll do, I'll give you one simple example to make you understand these provisions connected with duty drawback. Let me come to my Excel file. Hope you have downloaded this presentation material in Excel. I have shared the workings of previous class. If not, please download this material. Duty drawback. Now, let's take an example. So Mr. A has imported laptop for his personal use. Customs duty and taxes paid, say, under maybe for all put together, maybe for rupees, say, 36,000. Due to malfunction, the laptop has been returned back. Now, this is a very premature example where I, as an individual, I, as a end user, for my personal purpose, I have procured these goods. But I noticed that this laptop is not in a condition which I can use. So I've informed my supplier. Supplier said, so there is a courier who comes for pickup. Kindly hand over the document along with signed acknowledgement saying that this laptop is meant for personal use and due to quality issue, a email has been sent from the seller. So for a moment, Dell happens to be a manufacturer. So Dell says, please give a declaration that these goods are meant for personal use. So in that case, what happens to this customs duty 36,000? Now, option 1, claim a refund or absorb as a cost. Next, question number 2. So there is a importer. This is XYZ Limited. This company has purchased, say, a compressor or a plant and machinery. Plant and machinery whose value is, say, 35 lakh. So customs duty and the taxes all together paid for 25%. Say, this plant and machinery includes a air compressor, which is a component, whose value is, say, 45,000. The customs duty paid on this happens to be, say, 11,250. Now, in the process of installation, there is a malfunction of machinery. So this supplier whose engineer is working on the site, the engineer says that the air compressor should be sent back and new compressor to be imported. Now, this is a case where I, as a importer, I have paid customs duty of 8.75 lakh. In the process of installation, one of the component which have been used for installation, there was a malfunction. So this gentleman who has come for installation is saying, so I have to send back this air compressor and then I have to re-import one more air compressor. So this customs duty, what I have paid at the time of import, what needs to be done on this particular air compressor? So all these questions are answered under section 74 or 75, where they have used a terminology called duty drawback, where the customs law, which is most of the nations have the similar provisions across the globe. So one of the provisions is that whatever duty was suffered, let that duty be refunded back. Duty be refunded back as drawback. Now, this drawback is nothing but a claim for money what was subjected at the time of importation. Now, this could be either same amount or reduced on percentage of usage basis. Now, customs law says that, look, I am not going to give you the entire refund amount as it is. If you have used the goods for some point in time, I'll have a proportionate reduction in the customs duty and I'll give you the balance amount as a refund. The technical name for this refund is called as duty drawback. So this provisions under customs law, which are dealing with compensating back to the manufacturer for whatever duties and taxes paid in India, those goods are going to go out of India. The goods are going to go out of India. In that case, the customs provisions deal with the drawback provisions, where they say whatever duty you have suffered, you can claim that from the customs authority by way of a drawback. And even customs provisions permit the duty drawback on baggage provisions. For a moment. So there is a tourist who is coming into India. This tourist, he gets along with him, say, a motor vehicle. There are few people who are fond of motor vehicles. So they have their own personal motor car. So wherever they wanted to carry their motor vehicle. Even for a moment, bicycle. So when the bicycle is brought into India, you know that the general duty-free allowance is only 15,000. What if this tourist pays customs duty when he is bringing his bicycle into India? When he's taking back out of India, he says, look, I have brought into India along with my entry, I have paid the customs duty. Now, this bicycle I'm taking back out of India after my tour. So at that point in time, even duty drawback provisions can be applied for my baggage provisions. So this is a basic understanding to deal with my duty drawback. Now, provisions under this duty drawback are covered for today's discussion. One, under section 74, second under section 75. Section 74 deals with drawback where the exporter sends the goods in the same condition, re-exported as it is. There could be a scenario where I have given an example of a laptop. I, as an individual, I have purchased a laptop. I have, when I started using, there was excess heat being generated. Now, what I will do? I'll raise a complaint saying that, look, you have sent a laptop. The moment I switch on the power, there was excess heat being generated out of this laptop, or maybe some other technical issue. Say the display is broken, the monitor is not functioning, or processor is very slow. So on doing some test parameters, you're going to send it back as it is. Then I refer to duty drawback under section 74, where they say whatever duty you have paid is repaid back. It is repaid back to the exporter. So this pay provisions dealt only with as it is provisions. Second, duty drawback under section 75, where it says when imported material used in the manufacturing process of goods in India, and those goods are exported, Now, I'll give you the backdrop why these particular provisions were brought into picture. You have SEZ, then EOU, then you have the other STPA sort of organizations where you get the blanket exemption from customs duty. Now, what happens to other individual, say manufacturer, I'll say other business people who have DTA and exports. Generally, the organizations who are 100% into exports, they choose EOU, STPI or SEZ related registrations. The important advantage is they get the exemption from payment of customs duty. A very classic example, say I'm a software company. As a software company, I need to have, say, computer, laptop, then I have server, then electronic devices, I would say electronic network devices, and some other software, maybe in a CD or downloaded. Now, by and large, if you see their cost of operation, I would say cost of goods sold, generally, they have 30% is the hardware cost, 70% is the software cost. That's the manpower cost. Now, 30% on this, assuming effective customs duty happens to be 25%. Effective rate of customs duty happens to be 25%. So in case if there is a software company who have, say, 10 crores as a monthly cost, on that, 30% happens to be 3 crores. On 3 crores, 25% happens to be 75 lakhs. So every month on imports, they need to pay 75 lakhs as customs duty. Now, this 75 lakhs can be saved if I have registered as a EOU or SEZ. Now, this happens in case of a general exempted units. So in the ordinary business, when I talk about my DTA and exports, there could be a scenario where imports happen for raw material, plant and machinery, and consumables. So probably for a moment, let's assume that 60% happens to be DTA, 40% happens to be exports. Now, for a moment, I'll give an example. Say there is a software company, or I would say there is a company called ABC Private Limited, ABC Limited. There's one more entity called XYZ Limited. So assuming for a moment, ABC Limited have to provide design charges. And also XYZ Limited has to give a code for design charges. Now, if you look at both ABC and XYZ Limited, there is no level playing field as costing for customs duty. So there is an advantage for ABC Private Limited compared to XYZ Limited. So generally when we go for procurements, all the overseas customers will place orders on ABC Limited. To eradicate, to reduce or to minimize this exposure, the customs provisions called Section 75, which deals with drawback. They say that, look, if you're a manufacturer, if you're a processor, either a manufacturer or producer or a processor, means a unit which is into processing. Any of these units, they have imports. These imports are consumed in the process of production or manufacture, and the output is exported. So what they are saying is that whatever imports which take participation in these exports will be refunded back as drawback, as duty drawback. Now, this is a basic provision why my duty drawback provisions were brought into consideration. Now, whatever analogy I have explained all along is covered under Section 75. So we have two sections, Section 74, Section 75. So under Section 74, under Section 75, they brought in this particular provision saying that to have level playing field, any customs duty which was paid by a domestic manufacturer on those goods which have been imported or those goods which have been subjected to duty and taxes, which in turn gets consumed for a process which gets exported out of India. That point in time, to give you a level playing field, I'll give you a duty drawback as a refund. Now, this will help you to reduce your cost of operations. This is a backbone for your Section 74. Let me see if there are any questions so far. Purushottam is asking one more question. So in TCS provisions under Section 51, TCS has to be collected by e-commerce operator. If supplies made through e-commerce, such supplies made by the other suppliers, my question is that another supplier means, can we take other GSTN of the same person? For example, Mr. X has two GST numbers, one in AP and another in Tamil Nadu. X made the same supplies in the state of Tamil Nadu only through website, no physical orders accepted in Tamil Nadu. If branch transfers done from Tamil Nadu to Andhra Pradesh, order placed in Tamil Nadu by AP, order placed, if branch transfer done from Tamil Nadu to AP, orders placed in Tamil Nadu by AP is GST number of Tamil Nadu, has to collect TCs on branch transfers or whatever. Okay. Purushottam, it's completely a misunderstanding you are bringing in. You're trying to complicate the concept to the core. Make it very simple. What I'll do, for not to distract the attention, I'll just answer your question maybe at the end of my discussion. So I'll park your question for a moment. I'll give you a detailed explanation at the end. Moving further, is custodian agent of supplier? Custodian cannot be an agent. Custodian is just nominated by the government of India for the purpose of holding the goods till the customs duty is not paid. Custodian is not agent to any supplier anywhere. So please understand, Purushottam, custodian cannot be an agent or principal for anyone. Mansi is asking this question. So for jewelry, do we have to claim Rule 5 limit 50,000 or 1 lakh? First, then Rule 3 limit, is it so in this order? Good question, Mansa. I'll put it this way. Any exemption provisions, there is no hard and fast rule. I can apply Rule 4, I can apply Rule 3, I can apply Rule 5. For benefit of other students, I'll just repeat this question once again. One of the fantastic question where when I have a general duty-free allowance, let me just use another slide. When I have my duty-free allowance, say for a moment under Rule 3, I have a benefit of 50,000. Under Rule 5, I have a benefit of another 50,000. This is meant for, say, articles. This is meant for jewelry. Now, I'll make it a little more easy. 50-50 may be a little confusing. I'll make it 15,000. Now, question from Mansa is, in the process of finding out the duty payable, application of rule. Now, here, the fundamental rule set by various courts, whenever there is an exemption available, the assessee can choose the manner of exemption. Now, just to give you a very quick answer, now you have under income tax, say under new rule, under old method, under new method, under old method. So I can choose whether to claim benefits under Chapter 6A or not to claim benefits under Chapter 6A. Assessing officer cannot set aside my method of adoption and say, Praveen has to pay income tax higher if he has to pay under new route. Because he has adopted old route, he is paying lesser income tax. That contention of the assessing officer does not prevail. So coming back to your answer, your question. Now, always assessee can choose Rule 5, exhaust Rule 5, then exhaust Rule 3 or Rule 4 in whichever fashion you feel. There is no hard and fast rule. I can go whichever fashion I wanted to take the advantage. And very good reasoning, Mansa. So this is answer for your question. Then Mansa is asking this question. Motor vehicles are not covered under goods. Definitely, yes, Mansa. When I talk about goods, motor vehicles is not covered under the definition called goods. I've explained the logic. If this is part of baggage, then you will see all people who are coming from foreign, they'll claim baggage provisions and they claim incentives on that. And it becomes very tedious for various aspects. There could be undervaluation, there could be a pricing issues, there could be related party transactions. For various reasons, they have kept my definition motor vehicles outside the definition called goods. So first, these are the questions available. Students, just take your working note, make a entry in your working note. Please write down under duty drawback. Please put the heading duty drawback. Please put the heading duty drawback. Under that, write down section 74. Section 74. Write down drawback for goods. Drawback for goods imported into India. Drawback for goods imported into India and re-exported as it is. And re-exported as it is. Import of goods into India and re-export of goods as it is. This is covered under 74. Next, section 75. Next line. Section 75. Section 75 hyphen drawback of duties and taxes. Drawback of duties and taxes on imported material used in the manufacture / processing of goods which are exported out of India. Clear? Now, I'll move from here to the next provisions. First, I'll make you clear with respect to section 74. Slowly, I'll make you a little complicated provisions one by one to make you comfort in terms of understanding. 74, goods have come into India, goods have gone as it is. Now, I'll give you the preamble to make you understand this particular slide. So when I talk about 74, so there is a Dell laptop which has come into India on 18th July 2020. This was returned on, say, 25th July 2020. I call this as scenario 1. Scenario 2. Plant and machinery imported on, say, 15th December 2021, returned back on, say, 20th January 2022. Scenario 3. A specific tool which has been imported on, say, 15th March 2022, returned back on, say, 30th April 2022. Now, clearly follow this example. In case of Dell laptop, I can have something called identification. What do you mean by identification? Identification called service tag. Laptop which has come into India, now generally the invoice, the document, debit note, credit note, whatever you see, there should be identity. Now I cannot import, say, Dell XP laptop, Dell Extron laptop. I cannot send back Dell Asus laptop. Now, one model I have imported, another model I cannot return back. So when the customs, it is coming through customs and going back, obviously the customs officer expects to have a clarity. This is one example where identity of laptop can be established. Second, in case of a plant and machinery, I could have sent the machinery after usage or before put to use. Before put to use. Now, how does a customs officer get to know that the plant and machinery was used or not used? Generally, you have some identification marks. We call identification mark or seal. Now, most of these big machineries, when you look at these big machineries, they have a sort of seal for each and every operating channel. That means when someone wants to open that particular machinery, they have to break the seal and then open that particular machinery. So the moment someone looks at the machinery, was it in an open condition? Was it in a packed condition? This itself is sufficient for the customs officer to make a differentiation. Third example, when I talk about a tool, imagine a pen, what we have, say Reynolds pen or whatever it is. It looks just like a tool. I have imported 100 items and I'm sending back, say, 80 items. Now, in this case, there will be no identification, nor what I can say is there's no pattern which can be explained to the customs officer. Okay. Now, this is called partial return. Partial return. Now, please keep in mind these three scenarios when we talk about the duty drawback under 74. Now, coming back. So when the goods are being easily identified, So how do you find out this identity? Identity may be by way of the tag number which is available on the invoice. Identity may be by way of a survey report. Surveyor report. So generally what happens is when the customs duty assessment happens, there will be a person called surveyor who examines the goods and he gives a report called survey report. So this is one mechanism for me to give a identity of the goods. These goods which have been imported into India upon which any duty has been paid. Sir, how do I know that the customs duty has been paid? This customs duty can be established with reference to the bill of entry, where my bill of entry indicates the day when the goods have been entered and when the duty has been paid. So this is a reference to my payment of customs duty. Only when I pay customs duty, I can claim a duty drawback. If I have not paid customs duty, I cannot claim any duty drawback. Now, what they say? These goods which are entered for export, the proper officer makes an order for permitting the clearance and loading, or these goods are exported as a baggage. These goods can come as a normal export or it could come as a baggage. In that case, owner of the baggage has to give a identity and declaration as per section 77. Section 77, please remember, this refers to declaration. Declaration, what goods you have brought, how many pieces you have brought, and for what purpose you have brought. This declaration is good enough for me to show to the proper officer, look, when I came from Singapore, I have declared that I brought one bicycle with me. When I'm going back from India back to Singapore, I'm going to show the declaration which was made earlier under section 77. On the basis of that, this customs officer, who is called proper officer, will pass an order for giving the export and giving a duty drawback. Or the goods have entered for export by post, and the proper officer makes a permission for the purpose of letting this to be exported. In these three cases, they say 98% of the duty will be given as duty drawback. This 98% of duty will be paid back to the person who has imported and then re-exported. Imported and re-exported such goods. This is called your drawback under section 74. So what does the law say? 98% of the duty what you have paid will be given as drawback. So one of the important aspect is identity. So what if identity is not there? Let's read further. Now, in this previous slide, whatever I've explained, the first and foremost important point when you write duty drawback provisions, providing the identity to the satisfaction of the proper officer. Who is the proper officer? Maybe a AC or maybe a DC. This AC DC will be called as proper officer under customs law. And these goods which have been entered for export, it should have a time limit. What is the time limit? They say within 2 years from the date of payment of duty. So the day I have paid my customs duty, from there, within 2 years, this goods should be brought for the purpose of export. And on showing a sufficient cause, this period of 2 years can be extended by the customs board. So let me come to my Excel file just to give one example. Say, example number 1. Mr. A has imported a laptop during June 2018 and paid duty for rupees 45,000. So here, in this case, I have paid my customs duty on June 18. During February 2022, the above laptop has been re-exported due to quality issue. So there was a warranty and maybe extended warranty for 2 years, 3 years, etc. So this gentleman has sent back the goods on Feb 2022. Now, when I say 2 years, from June 18, my 2 years happens to be, say, June 2020. As per section 74, my time limit for export back is 2 years. My time limit for return back is 2 years. From where? From the date of payment. In this case, I have returned back the goods because of quality issue on February 2022. Now, they asked whether the assessee can claim a duty drawback. So you will say, as per the provisions of answer, you'll say, as per provisions of section 74, time limit for claim for export is within 2 years from the date of payment of duty. Since Mr. A has exported back after the above time limit, no drawback is permissible. This would be answer with respect to duty drawback under section 74. Duty drawback under section 74. Now, practically, examination, when you have a theory question for 3 to 4 marks, you have these points you can keep as a reference. You can keep as a reference for giving an answer how the drawback provisions have to be explained. First and foremost important point is identity. How do we establish identity? What would be the proper documentation relevant for this duty drawback? You will say that whenever we talk about duty drawback, identity of the goods should be established to the satisfaction of the proper officer. Then, availability of inspection report, as I say, this will be most sought out in case of plant and machinery or goods. Now, inspection report, you can ask the CHA to provide along with the import consignment. So generally when the goods are cleared from customs, you can get this inspection report along with your consignment cleared for domestic tariff area. Then date of arrival, examination, 1 mark MCQ can be expected for computation. Should I calculate the date of this 2 years? Is it from the date of arrival or is it on the basis of payment of duty? Answer, it is not on the basis of duty of arrival. It is from the date of payment of duty. So examination, 1 mark MCQ question. definitely you can expect from this particular duty drawback. Then goods partially re-exported, then you have a proportionate mechanism. Whatever goods you have paid, if you can establish that there is an identification available, proportionate duty drawback can be claimed as a drawback. Next. Now, so what if goods are used? Goods are used. Now, the moment I say duty drawback, when the goods are imported into India and then returned back. I'll give you a classic example where we can, people think of getting into a loophole, exploring the provisions under this LACNA. For a moment, let us presume that there is a pre-wedding shoot. Pre-wedding shooting. For this, I need, say, camera. I need some dress material. Also, I may require maybe some decorative items. Now, these cost, generally, if I purchase these goods, maybe it could be costly in lakhs together. So renting is something which is not generally that easy. So probably assuming that there is a person who is there overseas in US. Let's take this example. So Mr. A, who is there in US, he has his cousin brother, Mr. P in India. In US, there is a policy called return policy. Any goods which they have purchased, whatever be the cost of goods, over a period of 1 month or 2 months, if they're not happy with the commodity, they can refund, return back to the seller, and seller has to refund that money. Say all this material were purchased by Mr. A in US. He has sent those goods as a consignment to Mr. P in India. P has paid the customs duty and brought into India. He has used for his pre-shoot and he has returned back after usage. After shoot, returned. Now, this becomes a loophole for the customs authorities. The way the duty ought to be paid, where the service ought to be rendered in India, where the GST ought to be paid if any other service provider renders such kind of service. To tackle these kind of cases, they have brought this mechanism under Section 74, they say, where imported goods are used after importing, then the drawback is provided at a reduced rate. So this is fixed by the central government, having regard to the duration of usage. So on the basis of usage, I reduce the proportionate duty drawback and I'll give you a refund on the proportionate reduced value. If this mechanism is not there, most of the assessee would have enjoyed to purchase the material in overseas, get into India, use it for a while, then send it back again without payment of whatever that 98% is there. You would have claimed the 98% duty drawback. Let me see if there are any questions before I go further. CHA means clearing house agent. Maz is asking this question. CHA. CHA indicates clearing house agent. These are nothing but the agents who does the documentation, then what I can say, the process of filing documents, filing, inspection, survey, then payment. So generally, when the goods reach India, when the goods reach customs area for export, these are the agents, these are the people who have been authorized by the importer or exporter to file the documents, to make the payment of duty, for getting a survey report, all the process. We appoint a person called CHA, clearinghouse agent. Then moving further. Now, there are few conditions where they say Under this duty drawback route, there's a block, like you have block credit under section 17. There is a block list. There is a list of goods which are not permitted for duty drawback under 74. First and foremost, wearing apparel. Most of you know that this is one of the costly item. Like these days, when you look at this pre-wedding shoots or any of these commercial events, the dress which is worn by the bride or bridegroom, that itself will be costing thousands together, maybe a lakh also. So considering the kind of industry, this is one item where they say if the wearing apparel is imported in India and if it is used, then you will not get a duty drawback under section 74. Second, tea chest. Tea chest is more like your packing material. So any tea chest imported into India, used in India, then you cannot claim drawback on tea chest. Then cinematographic films. Cinematographic films. Then photographic films. In these four goods, if these goods are not used, after their importation into India, and if subsequently exported in the condition they were imported, then they would be entitled to 98% of duty drawback. Examination, 1 mark MCQ or 3 marks problem. Please expect 1 mark MCQ on this particular slide or 3 marks problem on this particular topic. What they will ask? Say Mr. A has imported a wearing apparel. The duty paid on that particular wearing apparel is say 48,000. On receiving this consignment, on opening the consignment, he noticed that it was a wrong shipment. What he has ordered, the color of the dress or maybe the pattern is completely different. So this particular Mr. X, when he sends back that consignment, can he claim a duty drawback? Now answer, you will say if the consignment, if the material was brought into India and without putting to use, the consignment was sent as it is, then you will say duty drawback is permitted under section 74 to the extent of 98%. This is one theory question where you can expect 3 marks or probably a 1 mark MCQ question. Mr. A has purchased some of clothing material from one of the designer in Singapore. He has used this particular material and he has written back after a period of 3 months. He wanted to claim a duty drawback under section 74 for 98% of the duty what he has paid. Examine the duty drawback. Is permissible? No, not permissible. Because the material was used for a period of 3 months, you will say no, duty drawback is not permissible. 1 mark MCQ question from this particular slide. Next. As I say, when the material were used after a particular duration of usage, the government gives a duty drawback. It says that I'm going to give you a duty drawback, but at a concession rate, at a reduced rate. Now, what does it say? In case if the goods are used not more than 3 months, less than 3 months, then you can claim 95% of the duty drawback. Now, please remember 98% without usage. Now, this 98% has reduced to 95% if it is less than 3 months. Now, this is a starting point to understand. Examination, you need to by heart this table. Probably you can make a table in your running notes. Before exam, please remember these percentages available. Reason, you can expect 1 3 marks theory question as a problem. 1 3 marks problem on the basis of period of usage. So if it is used for less than 3 months, I will get 95%. What if it is not more than 6 months? Say 3 months to 6 months. Then this 95 gets reduced to 85. Now there is a gap of 10% over here. What if it is more than 6 months, but not more than 9 months? 6 months to 9 months. Again, it is reduced further by 10%. What if it is more than 9 months, but less than 12 months? Now, instead of 10%, this is reduced by 5%. Now, for correlation, generally, 9 months is the point in time where the baby gets delivered. So keep that 9 months as a thumb point. Instead of 10%, this slab reduced by 5%. Now, examination, when you get this question, the way you can recollect, you have your working notes where you will say rough. There you put the table. 0 to 3 months, the 98 gets reduced to 95. 3 months to 6 months, the 95 gets reduced to 85. Then another 3 months. 6 months to 9 months, it reduced further by 10%. That is 85 becomes 75. What if it is exceeding 9 months but less than 12 months? Now, instead of 10 percentage, 5%. So that 75 gets reduced to 5%, 70%. Then further, if it is exceeding 12 months but not more than 15 months, 12 months to 15 months. Then instead of 70, it gets reduced to 65. More than 15 but less than 18 months. More than 15 but less than 18 months. Then 60%. If it is more than 18 months, no duty drawback. No duty drawback. Now, please remember, goods which have brought into India and put to use more than 18 months. In that case, your duty drawback is nil. As I have said, examination, generally, the question will be on the basis of either of these periods, either 12 months to 15 months, 15 to 18 months, or more than 18 months. Examination, again, I'm putting across a theory or a problem for 3 marks will be tested on this particular table. Pretty easy to remember. Don't have a fear that I have to mug up. Please keep in mind, if you can have a basis, have a strategy how to remember this percentage and this period, that becomes easier for to have solve this problem. So whenever a question is asked in this particular table, put a chart in your working note. On the basis of chart, you give your answer. Now let's take one example on the basis of this particular provision put to use. I'll come to my Excel file. Say, Mrs. ABC Limited have imported a tool for rupees 2,50,000. Customs duty applicable, say 18% ad valorem. After usage of the tool for 13 months, the same has been returned due to quality issue. Examine the duty drawback. So when you give your answer, please put it this way. Goods sent back as it is or after put to use. There is an entitlement of drawback, duty drawback under section 74. When you explain the theory, 3 marks is the weightage. So at least if you want to get 1 mark, if you want to get 2 marks, please elaborate the provision. Please explain the concept. Then you go to your conclusion. Don't straight away get into the conclusions in there. If it is between this 12 months to 15 months, you'll get 65%. Don't get into the answers straight away. Please put your answer first and foremost, the goods which are brought into India, on which the duty was paid, and if the goods are sent as it is or maybe after put to use, the entitlement comes under section 74. In this instant case, goods sent after use. Then proportionate reduction in the duty has to be examined. You will also say no drawback if the goods are used for more than 18 months. So as per the table, please refer to your institute material, page number 6.8. More than 12 months, but not more than 15 months. 65% is the duty reduction. So what you will say, Mrs. ABC Limited can claim 65% of the duty paid as drawback. Now, please don't use this DPK as it is in your examination. Don't use a shortcut. Write clearly drawback. Just for my convenience, I just say DPK. Examination, write in full drawback. Now, you will say duty paid at the time of import. You will say 2,50,000 into 18%. My customs duty happens to be 45,000. Customs duty happens to be 45,000. Duty entitled under section 74. Under section 74. You will say 75,000 into 65%. You get 29,250. 29,250. This is going to be your answer. So examination students, please don't miss this particular chapter. Easily you can score 3 marks as a problem or theory, 1 mark for MCQ for sure. And when you present your answer, elaborate your concepts. You will say that duty drawback is covering under 74 or 75. If it is covered under 74, you will examine, is it sent as it is before usage? Is it sent after usage? If it is sent before usage, 98% is a drawback. If it is sent after usage, that 98% gets reduced proportionately on the basis of age. If the usage is more than 18 months, there is no entitlement for drawback. This is how you conclude your answer. Let me see if there are any questions. I was expecting this question, Mansa. Now, Mansa's question, Mansa, you're asking for laptop example or this example? No? Okay. When you, okay, I'll re-explain this concept of time limit. Your drawback has a reduced percentage of benefit. Now, in this particular slide, let me come back to my presentation. A very interesting question from Mansa. Mansa is referring to this particular entry saying that if the goods are used for more than 18 months, my benefit of duty drawback is nil. She was referring, so there is a time limit for 2 years. Why is that you're not giving a drawback if it is used for more than 18 months? Now, I'll explain this way, Mansa. Don't get confused with these two aspects. It's a policy decision. It's a matter of policy. For two things. One, percentage of drawback to be provided. And matter of policy to set the time limit for filing an application for drawback. So here, Mansa, like we have section 54 under GST law, under section 54, within 2 years of payment of tax or interest or penalty, under GST law, what we will do when I have to file a refund application, the law says that within a period of 2 years from the date of payment of tax, please file your refund application. So similarly, under customs law also, the time limit to file an application for duty drawback is 2 years. What is that 2 years? They say 2 years from the date of payment, file an application for drawback. Now, if I have used the goods less than 2 years, maybe up to more than 18 months, Government of India says, I will not give any benefit of duty drawback. More than 1.5 years you have been using these goods. Why should I give you duty drawback? So they felt that substantial benefit of the asset was used. So let me not give a drawback if the asset was used for more than 18 months. This is a policy matter. But what is the 2 years we are referring? That is a time limit to file an application for claiming a duty drawback. Both are different footings, ma'am. Hope this is clear, Mansa. Hope this is clear, ma'am. Moving further. Now, so what if the motor vehicle, like as Mansa asked this question, does the motor vehicle get covered itself in the definition called goods? For the limited purpose of duty drawback, this motor vehicle is not covered under the definition of goods. For baggage provisions and drawback provisions, there is a separate treatment for motor vehicle. This motor vehicle alone has a separate treatment. So they say that different percentage of input has to be provided for the drawback in case of motor vehicles. If these goods are imported for personal or private use, then if sent immediately without usage, regular benefit, 98% of the duty paid will be given as a duty drawback. So what happens? If I've used this motor vehicle, then this is the rate which they have given. First year, they say every year, I'll reduce the drawback 4% per quarter for every quarter or part thereof. So effectively, for the first year, 16% is the value which is reduced on duty drawback. Second year, 3% per quarter thereof. Effective reduction, 12%. That means to say, if I have exported goods after 1 year, instead of 100, if I have paid 100 rupees, I would be entitled for 84% as duty drawback. Further reduced by 12%, it comes to 72%. And if it is used in the third year, every quarter, 2.5%. Every quarter, 2.5%. That is reduced to another 10%. So this comes down by another 62% of original duty paid. If it uses in the fourth year, 2% quarter thereof. So it becomes 8%. So effectively, it is going to be 54% of customs duty. So here, if the car is used for any of this first, second, third, fourth year, this is how my proportionate reduction happens in case of the motor vehicle, and I'll get a reduced drawback in case of this particular customs duty. Now, the question comes here. So you have given the benefit of the car for year 3, year 4. So this has an overriding effect of 2 years. So here, exception to the general rule. Exception to the general rule. Since the benefit of drawback is provided up to 4 years, this general rule, this is a general rule. What is the general rule? General rule, 2 years is the time limit from the date of duty payment. This is my general rule. Since there is a benefit for an SSC, which is given for year 3, which is given for year 4, this particular exemption, this particular abatement overrides the general rule. Accordingly, I'll get maximum 54% of duty drawback when the motor vehicle has been used for year 1 or year 2 or year 3 or year 4. So what happens if after year 4 I have exported? I'll not get any duty drawback thereupon. I'll not get any duty drawback thereupon. Hope this is clear, students. Motor vehicle, very rare you can expect questions, but other than motor vehicle, you'll get a question on the basis of this table which I have explained. 0 to 3 months, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18. Expect one question from this particular first table. Then this last point I have summarized once again, saying that no duty drawback shall be allowed if this motor car has been used for more than 4 years. Maximum in a period of 4 years, I have to claim a refund duty drawback of that commodity. Now, manner in time limit. Whatever form, like we have GST RFD 01, the claim for duty drawback shall be provided in a prescribed form. And from the day the goods have been permitted, from the date on which the order has been passed by the proper officer, from there, within a span of 3 months, I have to file an application for getting a refund. Generally, the time limit is 2 years from the date of payment of duty. 2 years from the date of payment of duty. So what I have to do? I have to ensure that my goods should be brought to export for export. File an application, either shipping bill or bill of export. Bill of export. And the order should be passed by the proper officer. From the date of order, within 3 months, I have to file an application. And this application overall, you have to ensure that within 2 years from the date of payment, you have filed this application. To file an application, the goods should have come for export. Once the goods have come for export, the proper officer has to pass an order. So overall, you have to ensure that you have brought the goods for the purpose of export, and within a span of 3 months from the date of order, I have to file my application. Let me see if there are any questions. Balaji is asking this. Balaji says, so please repeat once again. I'll explain again this way, Balaji. Say 30th June 2020, goods have duty has been paid. So technically, 2 years time limit is 30th June 2022. So what happens here? The importer brings the goods for re-export. This goods are brought on, say, 30th September 2021, maybe after usage, whatever be the point in time. So here, when the goods are brought for re-export, this is entry into customs area. Say, proper officer passed an order for export on 15th October 2021. Now, the gap here will be general formalities, like goods have to be inspected. There should be corresponding documentation to be presented for export. Assessment, if at all, if there is any export duty has to be paid on these goods. Also, there should not be any prohibition for the goods which have to be exported. So there are various checks and balances, Balaji, where the moment, like if I want to export, I cannot say, I'll give the laptop to DHL. DHL will export these goods as it is. It has to flow through various stages where the corresponding proper officer passes an order saying that let these goods be exported out of India. Once I get an order for export, I call this as let export order. From there, within 3 months, application has to be filed. With a proper officer. Why? Now, please remember, for claiming drawback, goods have to be exported. Goods have to be exported for claiming drawback. Now, when you file your application, Balaji, how does the proper officer know? Like the officer who's sitting in customs, your jurisdictional officer, both are different people. The officer who sits at your jurisdictional range, how does he know that these goods have been exported? He will not know unless you show this order passed. Unless this order is passed, along with this, you give your application. Both have to be given to your range officer, right? So that is the point in time you're going to get this particular duty process. Now, when are you going to file your application? This 15th October 21, your order is passed. Say 30th October 2021, you file your application. Now, when you file this application, look at this date. I call this as A. I call this as B. From the date of payment of your customs duty, on or before 30th June 2022, you have to file your application for drawback. Now, when did you file your application? You filed on 30th October 2021. Is it prior to that 2 years time limit? Answer is yes. Then you will be entitled for the percentage prescribed under Section 74. This is the process involved now. Hope this is clear, Balaji. Let me see if there are any questions. Great. So far, so good. Let me come back to my presentation. So what if my application was filed instead of 3 months with a late fee? Maybe with further late fee, another 6 months I have filed my application. Then there is something called a late fees. Like there is something called condonation. Generally, when you have to file your appeal, there is a statutory time limit. If there is a statutory time limit, on the basis of principles of natural justice, there will be a condonation delay. Means the assessee should be given a second opportunity. You have given one opportunity. For some reason, he couldn't meet with your expectation. Principles of natural justice give a condonation. Similarly, here they say there is a condonation of further 3 months at the ACDC, further condonation of 6 months at commissioner or principal commissioner, where there will be a late fee payable maximum of ₹1,000. At there is a condonation fee or late filing fee, or there is a condonation fee of ₹2,000 at the concerned commissioner or principal commissioner. In the case of ACDC, 1% of FOB value or ₹1,000, whichever is lesser, 2% of FOB value or 2,000, whichever is lesser. This will be collected as your late fee for the purpose of condonation of your delay in filing application. Examination, 1 mark MCQ can be expected. Now, these are all pretty simple. Is there a condonation? Answer is yes. What is the condonation fee? 1,000 or 1% of FOB at the ACDC level. Next level, commissioner or principal commissioner, further period of 6 months with a late fee of 2,000 or 2% of FOB value. Next, we'll move on to next aspect called Section 75, where I have filed my application, where my imported goods have been used in a process called manufacture. Goods are used in a process called manufacture. I have given example, the concept behind this process, level playing field, or to make your prices competitive. Now, most of the, you would have done internal audit, you would have done statutory audit, where you would have seen under miscellaneous income, you would have credited drawback income. Now, this drawback, as I have mentioned to you, the backbone, the concept behind this drawback under Section 75. Drawback under Section 75. My customs duty or taxes on imports or central excess at one point in time. We were talking about Customs Act 1962. Customs Act 1962. This Customs Act 1962 has not changed by and large because it was made at par with World Customs Organization's provisions and principles. So though the GST was brought in, VAT was abolished, the sales tax changed to VAT, VAT was changed to GST. Minor changes happened with respect to central excise or GST related provisions. So they say if any excise or GST was paid on goods consumed for manufacture, For a moment, I'll give example. There is a provisions under Section 17 of GST where there is a blockage of input tax credit. So assuming for a moment I'm a manufacturer. Look at my composition. I have raw material. I have my say consumables. I have my overheads. I have my power and fuel, maybe say diesel for power consumption. Now, all these items, when I put into my cost sheet, COGS for the COGS computation, there could be a composition of this raw material procured, which is by way of import, which is procured by way of a domestic. So there could be a composition where my 60% of raw materials are imports, 40% are domestic. Consumables, say 80% of my consumables are imports, 20% is domestic. Then overheads, 40% of my overheads are imports, 60% is domestic. And power and fuel, there is no imports, maybe everything is domestic. Now, in this pattern, there is a consumption which is happening in your manufacturing or production, which eventually go out of India as exports. So keeping this particular logic, keeping this pattern in logic. Now, for a moment, assuming that you are in one of the empaneled committee as duty drawback fixing committee. Now, this is actually there, not that I'm giving a hypothetical example. This is actually there where the committee is a panel of experts who have a knowledge on manufacture, production, costing, taxation, international taxation, banking, and also to some extent marketing field. So what does this committee do? They take your financials, they take your industry, they try to understand. Now, say for a moment, rubber industry, say tire manufacturer, you have MRF, Seat, Dunlop, Apollo, like various industries. Now they will compare these particular manufacturers with another set of traders. Now, if the goods are manufactured in India, what is the cost? If these goods are imported into India, what is the cost? What is the burden which is being caused to the industry which is procured, manufactured in India? And for a moment, if these goods are sent back out of India, like we have discussed something called anti-dumping duty, countervailing duty, protective duty, right? Subsidized duty that covers under CVD. So in all these cases, the way the imports were made at a premium, the same way this empanel committee tries to examine what is the contribution of this industry as exports. Now, when you have to keep exports reasonable, That means to say the pricing should be competitive. Pricing should be competitive. So what they will do, goods exported, they will try to understand if a customer in Singapore, if a customer in Singapore has a choice, he can buy the goods from India, he can buy the goods from China, he can buy the goods from, say, US or any other nation. Now, what is the price happening from India? What is the price from China? What is the goods from US? Putting aside all your technicalities, what is the production cost? What is the technology you've used? What is the composition of raw materials used? Now, on the basis of all these parameters, you as a committee have to decide, have to take a decision for fixing the benefit, fixing the benefit. So this is what is discussed under section 75. All these are the gamuts which are covered under section 75. Where now some of you who are listening to me, if you think, so what is the career? What is the advantage for reading these concepts? If you happen to take up your civil services, say UPSC exam, where you want to get into Indian Revenue Services, where you get, like, if you're very good in your fundamentals, you should know your tax laws, you should know your economic laws, you should also know your financials. If you're an expert, where you can bring a value addition, that means how to read the financials, how to make a meaning out of the financials, a way to look for costing elements, way decision will be made with respect to purchases. Now, as a chartered accountant by default, you know how the financials are prepared. You know how the notes to accounts is prepared. You also know how this related party transactions are dealt in your international taxation. What is the arm's length? What is the price which is imported into India? What was the duty suffered by way of anti-dumping duty, etc.? What happens if the goods are sent back out of India? All these are the plethora of questions which are put forth before the committee, where you come out with a conclusion called duty drawback under section 75. So this is a preamble, students, for you to read and appreciate how you're going to use as a career point once you get qualified, once you get into this forte. You have two choices. One, get into the Ministry of Finance by way of this civil service route, get into this TRU for the purpose of taking decisions, or get into the practice where you help with the assessee to understand the nitty-gritties of these tax principles. What is the analogy for the government to set these particular various provisions, and help the assessee to make a decision where to claim a drawback, how much drawback can be claimed. Let me get on to the provisions under section 75. To start with, goods are exported entirely in a different form. This is my starting point. When I talk about section 74, identity is established. Under section 75, identity is completely changed. So here they say the inputs could be either imported goods on which customs duty has been paid, or it could be indigenous goods. So I have given a chart. You have to make a composition. How much is imported goods? How much is indigenous goods? And this indigenous goods, where there was a excise duty which was paid. As on today, only petrol and diesel on which or tobacco products which you have excise duty being paid. The existence of these imported or indigenous excise duty paid goods in the final goods. Existence. Now, this is a very, very important principle. This existence of the imported goods, the existence of these indigenous goods in the final products, I call this as final products. Now, it is very difficult to identify or to establish its existence. Like if you imagine a tar for this bitumen, which is called as a damper. If you remember this normal roads, black color roads, you have this damper, which is bitumen, which is in liquid form, which is applied as a tar to make the solid condition. Now, to get that bitumen, what you will do, you will put grease, you will put this, what you call black powder, carbon, you put components like Fevicol for making a adhesive. When it is in a hot form, it is a liquid stage, which is called as a liquid bitumen, which is called damper. This damper, once it gets dried, it becomes a hard substance. So in the process of manufacture, I could have imported consumables, I could have this indigenous goods. So the loss is that it is very tough for identification. The goods, namely inputs, might have undergone change in the physical shape or property. In the physical shape or property. The quantity of inputs as per piece of the final product may not be uniform with the inputs. So what is my input? What is my output? Is completely uncomparable. This is where Section 75 comes in. Says, under these circumstances, we give a benefit called duty drawback under Section 75. Students, we are at 7:30. Let's have a break for 10 minutes. After 10 minutes, at 7:40, we will reassemble back for further discussion. Let's continue with our discussion. There's one question asked by Manasa saying that, sir, in page 7.8, there's a note where it says if imported goods are merely tested, though not used, it will be treated as used after importation. So here, Manasa, generally, when we import the goods, it so happens that how does the importer gets to know that these goods are in good condition? Not in a good condition. Only when they do test parameters, when they do this quality check. For the purpose of export, the person who is there in overseas, he should get a quality report or test report. So for that reasons, if I have done that for testing purpose, mere testing purpose, even that it is presumed that it is meant for use, or if it is after usage. It's like, say there is a brand shirt. It's a brand new shirt. It has come in a pack condition, Manson. I have tried the shirt. I found that it is 2 inches short compared to my shoulders. Now, how do I get to know? Only when I put on the shirt, I get to know. So I'll pack again. I'll say, look, it is not in a proper condition. I'm sending it back. Now, for various reasons, this note says that any goods which have been put to use, that means any testing carried out, it is presumed that those are put to use. So that's how you have a reduced rate instead of 98. 95% is a customs rate you'll get as a drawback. This is a concept behind excluding that activity called testing. So even if you have done testing, it is presumed that goods have been put to use. Hope this is clear, Mansa. Moving further, now I've explained the analogy, I've explained the concept, how this committee examines the industry and then they come into a decision to fix this particular duty drawback. So the principles for them, considering the usage, considering the mode of usage of the goods, which is imported and consumed. So first, they try to examine, are there any imports? And those imports, have it been consumed in your manufacturing activity? Also, they're trying to examine they shall be allowed duties of customs chargeable under this act or any imported material or class of material. If there is any duty chargeable on a particular class of materials which are coming for export, that also they will take into consideration. It is comparing the like or similar goods. Then they are using those goods for the purpose of manufacture or processing. In these cases, they say the central government, who is going to determine? The central government may, by a notification in official gazette, then that drawback shall be allowed at a rate to be fixed or notified. To be fixed or notified. So generally, by way of a notification on the basis of central excise tariff rating, or I will not say CETH, on the basis of HSN, they will fix something called duty drawback under section 75. I'll quickly show you a couple of duty drawback available. Let me just see where is the screen available. Yeah. Let me share my screen. Hope you're able to see my screen now. Here, I have taken example for chapter 85. Now look at the heading, rate of duty drawback effective from 4th February 2020. Tariff number. For the tariff, what is the general description? For this, what is a unit of measurement? And what is a regular duty drawback rate? So this column is giving 1.8% on FOB value. And also they have given cap per unit in rupees. So when they wanted to give a duty drawback for first item, there is an item called 8501, which deals with electric motor and generator. Now this is a DG set, generally what we call. So if this electric motor, which is having a tariff HSN 8501, This 8501, I'll get 1.8% of FOB value as my duty drawback. Please remember, this refers to FOB value, not CAF value. And also, every duty drawback, they have a capping. For an instance, let me scroll down. Yeah. Now, if you look at chapter 85, 1701, cellular mobile phone with or without accessory. Like for an instance, we have this entity called Foxconn, who are into manufacturing of electronic chips. So this entity Foxconn, they manufacture, they do the assembly. They do the assembly of mobile with the integrated circuit and manufacture mobile. The Apple iPhones are manufactured in India. So in case if these goods which are imported on which you have paid customs duty, either you get 4% of FOB value as duty drawback or maximum 350 rupees is what you get a duty drawback per piece. So if I have exported say 10,000 or maybe 50,000 is the value of FOB value. On 50,000, 4% happens to be 2,000. Either 2,000 rupees or 350 rupees per piece, whichever is lower, that will be allowed as duty drawback. So this is a capping. 2,000 is a duty drawback, where the ceiling is up to 350 rupees. So this is how the government, by way of a policy, by way of a notification, fix a duty drawback for a particular item. Let me come back to my presentation. So here, whenever we refer to section 75, government is going to decide my duty drawback. Difference between 74, 75, I try to explain. I'll just skip this one. Now, duty drawback, when I say, they say that there are few scenarios where my duty drawback is not allowed. Duty drawback is not allowed. Examination, 3 marks a problem will be asked from this particular slide. They'll give you a scenario and they'll ask you to examine whether this particular transaction, you get an entitlement of duty drawback. Now, you are a best person to imagine this kind of scenario as an expert knowledge you have. You're just one step before clearing, getting a professional degree called chartered accountancy. But more or less, you have a capability to visualize all these concepts and provisions, provided you get an opportunity to draft these conditions. So one of the conditions, first condition, they say export value of the finished goods, or the class of goods is less than value of imported material. It is less than value of imported material, which is used in the manufacture. Then you're not entitled for duty drawback. Simple terms, they say you have imported, say your raw material for say 1 lakh. And your export value, FOB, is say 80,000. They say that because your export value is less than the value of imported material. Please look at the language. They don't say duty paid. My value of imported material. So where do we have this kind of circumstances? Where do we find that my value of exports is much less than the consumption value? Probably where you have this subsidized goods. Subsidized goods. You remember the provisions of anti-dumping duty, countervailing duty. Now, there could be a scenario where my export is much, much lesser compared to the value of goods on which I have paid my import duty and all. So in case they say the value of exports is less compared to the value of imports, you are debarred from claiming a drawback. This is your scenario 1. Scenario 2. In scenario 2, they say my export value is not more than such percentage. They're going to give a percentage of value of imported materials used in the manufacture and processing of those goods, as may be notified by central government. So what they're saying, in case if your export value is less than a percentage of the value of imported material, here straight away they are saying that it is less. In the second scenario, they say if it is lesser by a particular percentage, then you are debarred from claiming a drawback. Third, you have a scenario where your money, sale proceeds, is not received in a convertible foreign currency as per FEMA regulations. As per FEMA regulations. Most of these benefits, like exports under GST law, exports under customs law, they insist that you have to get the money in foreign currency. So if you fail to get the money in foreign currency, you are debarred from getting the benefits under 75. Moving further. In this backdrop, the government has, like Section 75 says that they will formulate rules point in time for calculating what is the amount of duty actually paid and average of a duty on a particular class. The government is trying to make a formula to determine what duty I can pay, what duty was actually paid, and what is the average amount of duty which is getting consumed. So they are going to evaluate a formula or a method for determining my duty. Also, the government says that there are few class of goods on which I don't permit my drawback. Like you remember in the previous slide, a couple of previous slides, the apparel textiles, T-chest. They said if any apparels are imported after usage, if you want to export, send back, then they said there is no duty drawback permissible. Similarly, in this case of 75, even though I have put into manufacture, where the government feels that there is a threat to the Indian economy, they may block your duty drawback. And recovery or adjustments. Recovery or adjustments. Say there is a procedure, there is a percentage laid down, and over a period, there is a change in the manufacturing process. For this clause C, I'll give an example where you can appreciate better. Imagine motor car. 1990s, 2000, 2010, 2020. You don't have this automation in your vehicle. So there is a lesser usage of technology. 2000, you had more dependency on iron for the manufacture of a vehicle. Fiber content has replaced usage of iron. 2020, weightage was more for what I can say is lighter components with more technology. Now, what is happening here? The pricing in 2020, I pay more towards technology, automation. I should have auto power window. I should have power brakes. I should have this navigation sort of thing. Now, when we look at this industry called automobile sector, the situation prevailing in 1990 was completely different after a decade. After one more decade, there was a completely shift on usage of my raw material or my consumption pattern. More dependency from iron or steel, it has come to fiber. So naturally, there is a reduction in price. There is a increase in profits. So what happens here? My duty drawback rates have to be revised on every periodical basis based on change in industry's practice. Similarly, this is one example for your automobile sector. Imagine maybe your, say, computer sector, laptop or electronic goods. Industry to industry, there will be a change in the platform. There will be change in the operational methodology. All these are the reasons where this drawback rates have to be revised on a periodical basis. So that means the government has got this committee who are going to evaluate that there is a change. Whenever there is a change in the procedure, either they will pay more or they will recover from you. Recovery. In 1990s, I was getting paid 5% as a drawback. Way back from 1990 till 2010, if I keep the same 5%, automobile industry is going to get much, much higher benefits than what it should have been paid. So the government, by way of a notification, makes some retrospective amendments to either recover or to pay on the change in the process. Moving further. Now, in the process of this duty drawback, they say that to provide you a duty drawback, they need evidence, some sort of documents, some sort of certificates which are relevant for the committee to examine industry to industry what you have been carrying on. For simple example, there's one company which has started its operations in microchip manufacturing activity. There's something called this Make in India. Make in India. So how do we get this Make in India? You have to get a certificate from one of the Chamber of Commerce. The Chamber of Commerce, generally they do give a registration, they examine the industry and then they give a certificate called Make in India. This has to be provided by the exporter to the proper officer along with the application. This is one of the expectation. Also, in the process, the proper officer who is going to give you the duty drawback, they have to gain a knowledge. They have to gain knowledge of your business. How does that happen? They may call for documents or they will visit your premises to understand what process you do in your factory. So this is also one of the requirement under duty drawback. Further, they say there is a time bound within which you have to file your application and also how the payment happens in respect of consignment which is exported out of India. Now, there are three mechanisms where the duty drawbacks are permitted as on today in India. There are three rate of drawbacks. One is all industry rate, rule 3. Students, please take your working note, write down. Examination, you can expect one theory for 3 marks, 3 for 3 marks or problem for 3 marks from this slide. Write down rule 3 hyphen all industry rate. Rule 3 hyphen all industry rate. Rule 6 brand rate. Rule 6 brand rate. Rule 7 special brand rate. Rule 7 special brand rate. Now I'll explain you this concept. Some of you are listening to me. If you think, so what is the value add which we are going to make in our career, in our profession? This one slide is good enough to draw your attention maybe in the interview when you are attending any of these sentences. Now, there is something called all industry rate. That is as per rule 3. Then you have something called brand rate as per rule 6. Let me put it here. Rule 6 brand rate. Rule 3 all industry rate. Then you have rule number 7 which talks about special brand rate. Special brand rate. Now, all industry rate is a general rate by way of a notification in official gazette. Now here what happens, as I have given you a backdrop, there is a committee. Committee is going to come together to understand in general. So let me take example of pharmaceutical sector. So in a pharmaceutical sector, they try to understand what drugs they import, what raw material components they import, how do they do a manufacture, what is it they are going to export. So they may fix one particular rate. Similarly, it's a oil industry. In case of coil industry, it's a regular coil product. You import, you put it to process, and then manufacture coil products, then export. They'll give industry specific, depending on the need and manufacture. They say this is your duty drawback. So this is a general rate available to industry in general. Now, what if there is a entry missing for a commodity? In this case, you may approach this committee, the authority concerned, to fix something called brand rate. That means you approach the committee to fix a duty drawback, under rule number 6. So wherever my nature of industry is such a way that there was no identification in general notification they have given, then I approach the concerned commissioner or principal commissioner with an application where I explain what is the nature of business. I explain what is the composition of my raw material, what is the process I undertake, what is the value addition I make. Finally, what is the price I'm going to export it, and what is the nations where I'm going to export. Now, on the basis of this factual data, the decision made by the authority or committee is called fixing the brand rate under rule 6. Now, from here, I move on to the next category called rule 7 special brand rate. Now, this is a category where, sir, I have general rate, duty drawback rate, but this is not compensating the duty suffered. That means to say, my drawback, what I'm getting is less than 80% of my duty paid. Say for a moment, 10,000 is the accessible value. General rate, say on 10,000, general rate of drawback is 2%. So this happens to be my drawback of rupees 200. So this gentleman comes and says, sir, on my purchases, I'm making a payment of duty at the rate of 18%, which comes to 960 rupees. The customs duty suffered on my purchases is 960 rupees. Now, if you look at it, my duty paid on this 18%, if I take, it is much, much higher compared to this rupees 200. So in these cases, I, as an importer, I apply to this authority under rule 7, saying that, look, you have given a rate, but this is not lucrative enough. So please give me, on the basis of my factual submission, a rate called special brand rate. This is a backdrop where choice number 1, look at your all India rate. What is the goods you have? On the basis of goods, whatever duty drawback they have given, take that and be happy with that. So what if I don't find my name, my product name entry in this all industry rate? Then approach this committee under rule 6, saying that, so please fix a customs duty drawback, which is called brand rate. So on the basis of factual information, the authority concerned fixes a rate called my brand rate. Altogether, I come into a different bucket where the rate of drawback which was given is not lucrative enough, is not promising enough for this particular manufacturer. In those cases, this particular manufacturer says, sir, you please fix a rate which is called special brand rate. This is under rule number 7. Question comes here. Sir, a person who has a general rate available, can he approach under rule 6 directly? Answer is no. When there is an entry found in rule number 3, I cannot approach the authority for rule 6 fixing separately. Also, sir, what if already I have enjoyed the, I have, as an exporter, I have enjoyed the regular drawback. Now, what to be done? Now, what to be done? Now, if you have enjoyed the regular drawback, don't file an application under Rule 7. Alternatively, sir, I have applied for Rule number 6. The committee has fixed 3%. The committee has fixed 3%. Over a period of time, this was made as a common entry for 2%. So can I again approach for Rule 7? Answer is, once you got a rate fixed under Rule 3 or Rule 4, Rule 6, you cannot file an application under Rule 7. This is a general theory. Examination, they will not ask the exclusive provisions. They may ask you a provision. What is the difference between Rule 6 and Rule 7? What is the difference between all India rate and brand rate? What is the difference between all India rate and special brand rate? So these are the provisions connected with these three modes of classification. Coming, there is a rules. Now these rules, students, this is just for your knowledge purpose. This is only for knowledge purpose. Examination, you may not be tested on any of these provisions. These have become rudimentary, residuary as on today. But for the purpose of appreciating the concept, how the drawback fixing happens, what is the purpose, we just need to refer. So what I'll do, I'll just touch on concepts which will help you in your career point of view. Now, as a committee, how and what basis the drawback will be fixed? As I said, they will look at the average quantity or average value of consumption. What are the materials which are getting consumed? What is the average quantity of goods which are imported in the manufacturing of process? What is the average quantity of materials which are semis or components which are intermediate products other than the raw materials which are used in the manufacture? So here you have various mechanism where my duty drawback is determined. I have various modes under which the decision is taken by the committee. In the process, you will also see what is a production process, manufacturing activity, what is the wastage, how much benefit has to be reduced to that wastage involved. Then, what are the packing materials which are required for this processing activity? Also, any other information where central government feels that it is relevant for fixing the drawback. Now, like your section 74, similarly in 75 also, time limit from the date you get the permission to export, within 3 months file an application to claim the drawback. Now, so rule 7 I've said, where my benefit of rate under rule 3 or rule 4 is less than 80% of the duties paid. Now, this is a reason why rule 7 is being thought for. So, if I don't get a benefit of rule 3 or rule 4, where it is not compensating, I have to prove that the benefit what you are giving is less than 80% of the actual duties paid. Then you will get a benefit under rule 7. So they say that if you have already made a claim, for duty drawback under rule 3 or rule 4, I cannot make an application under rule 7. That means since I accepted, when I filed a claim, it is deeming that I accepted rule 3 or rule 4. Once I accepted rule 3 or rule 4, I cannot make an application for special brand rate under rule 7. Now, this is 1 mark MCQ question. This is 1 mark MCQ, which will be tested in your exam. Cases where no amount of drawback is to be determined. So what they say, my value of export is less than the value of imported material. Then I cannot claim any drawback. Or as a percentage, if the value of exports is less than the value of percentage of imports, I cannot claim drawback. What is that rate? I'll explain here. They say my drawback when you are claiming, there is a cap, there is a ceiling. There is a ceiling for maximum permissible limit. If my export value is say 5 lakh. On this, say drawback permissible is say 5%. This comes to 25,000. My market value of goods is say rupees 60,000. My market value of the goods is 60,000. Now look at here. My actual market value is 60,000. The exporter has intentionally jacked up the export value by 5 lakhs. Maybe after that point in time, a credit note may be issued, some price adjustment will be done, some sort of gimmick will be done. So here the provision says that 1/3 of market value, 1/3 of 60,000, I get a value of 20,000. So when a drawback should be paid, they say, though you are entitled for 25,000, this is restricted to 1/3 of market price. So in this case, drawback permissible is rupees 20,000. Examination, expect 1 mark MCQ question where they'll give you the value of export, FOB value. They'll give you the drawback rate. Applying both, I'll get my drawback eligibility. They'll give you market value. What is the cap in respect of drawback? 1/3 of market value is the maximum amount I should claim as a drawback. So here they say that 25,000 is your drawback you want to claim. Market value is 60,000. 1/3 is 20,000. So here, though I'm getting 25,000 as a rate applicable, maximum I can pay under Section 75 is rupees 20,000. Let me see if there are any questions so far. So far, so good. Now, interest. What if the government makes a delay in payment of interest? Now, most of you are aware that if I have to get a refund, 6% is what government will pay me. If I have to pay, 15% is the interest I have to pay to the government. So under Section 75A, as on today, they say that if the government has to give me a drawback, but they cause a delay in making the payment, but causing that delay from the date of filing an application within a month, if I don't get my drawback, from completion of that 1 month, I'll get a expiry of the same period of 1 month. I'll get my interest at the rate of 6% per annum. Alternatively, if there is a erroneous drawback, I claimed a drawback, erroneously they have given a drawback, then I have to pay back this demand, that drawback, along with the interest. How much is the rate? 15%. From the day I receive that money till the day I pay back, 15% is a duty drawback. I cannot claim a drawback if my refund value, drawback value is less than 50 rupees. Now, this is a little important. Prohibition under 76. General theory, when can the drawback be prohibited by central government? Now, the central government, where they get a intelligence news that the goods which are being exported may most likely can come back to India by way of smuggled goods, then they may restrict that drawback, saying that on these goods I may not permit drawback. Now, generally, how do they get this information? sudden surge in your exports, sudden surge in imports. Particular commodity, there is a hike of fluctuation of goods which are getting out of India. That could be indication that there is a goods which are getting smuggled back into India. They may restrict a ban for a particular point in time. Now, we are at 8:15. We are moving to the next topic called refund under customs law. Now, this refund under customs law, you can expect a theory question. Just give me a minute. Drawback, section 74, section 75. Refund, section 27. Refund under section 27. Examination, there is a mutual exclusive concept. I may be asked a 3 marks problem plus 1 mark MCQ. 3 marks problem plus 1 mark MCQ. In refund, you may be tested 4 marks theory question. 4 marks theory question. This is how your examination, they will test your knowledge on either drawback or refund. Please keep in mind, students, both are mutually exclusive. So either you choose to read drawback or you choose to read refund. In refund, it's hardly 4 or 5 pages, which is revolving around the theory of refund and the concept of unjust enrichment. Before this, I'll make you clarity with respect to what is a drawback, what is a refund. Hope you're able to see my Excel file, students. Duty drawback. Generally, this is a scenario where my goods imported are re-exported. When I talk about a duty drawback, goods which are imported and these goods which are exported out of India, then as it is, I call that as a duty drawback. 98% is the amount of duty drawback I will get. Alternatively, I could have a scenario where the goods are imported into India which are damaged or defective. I'll send back without usage. From the export, as it is, I'll get again a duty drawback. Third, on the basis of my manufacturing or production, government may formulate a policy to calculate, to make a level playing field, to incentivize the exporter, which is called as duty drawback. On the other hand, when I talk about refund, refund comes into a scenario where government pays back the money of duty or tax. Government gives back the money which is paid as duty or tax. Now, why does the government pay back that money? Probably, I have paid this duty under protest. I have paid this tax under protest. Why did I pay it under protest? I have gut feeling that this is not subjected to customs duty. So those point in time, when I challenge the levy itself, the levy, if it has been decided by the court by way of a decree, then I may be entitled to claim a refund of the duty or tax which have been paid. So generally, the constitutional matters where the levy which has been demanded, the amount which is not to be paid, which is eligible to be given back as a refund. Alternatively, there could be a scenario where duty or tax paid in excess of actual payment. Now, there could also be a scenario where, say, while filing my bill of entry, I have to pay my customs duty of 10,000 rupees. In my bill of entry, the proper officer who did the assessment, he also approved for paying customs duty of 10,000. My accountant, while filling this challan, TR6 challan, which we call online, instead of entering 4 zeros, by mistake he has entered 5 zeros. 10,000 was entered as 1 lakh. So what happens there? 10,000 will be appropriated towards the duty. 90,000 which are paid excess, I'll claim a refund from the government. So students, this is a thin line of difference between your drawback and your refund. So refund comes into a scenario where you don't apply your consumption, usage pattern, etc. This is more on a technical side where either you have challenged the levy or you have paid a tax or duty which is ought not to be paid. Where the government, by way of an exemption notification, they say these are the such circumstances where the duty is not to be collected. All those cases, I can file an application called refund. Another example, provisional assessment. Provisional assessment. Now, when in case of provisional assessment, I don't know exact duty. So I have paid, say, 10,000, where after the final assessment, 6,000 was the duty which was determined. So that 4,000 what I paid excess, I can file a refund application under section 27. So duty drawback is covered under section 74, 75. Refund is governed under section 27. Hope this thin line of difference is clear, students. Examination, mutually exclusive, either refund or duty drawback would be tested. Let me come back to my presentation. Now, first and foremost, to begin with, how does the refund process starts? The refund process starts while filing a refund application. This application can be filed by a person who has paid the duty or interest, or the person who has borne the instance. The person who has paid the duty or the person who has borne the instance of such duty or interest. Either of these two is the person who has to claim refund. Either of these two has to claim a refund. Now, I'll give a couple of examples so that you can understand these concepts in a better fashion. Scenario 1. Scenario 1. Exporter. Let me talk about export little later. Importer paid customs duty at the rate of 12% used in manufacture. Government, by a notification, reduced rate to 8%. Say retrospectively. Scenario 2. Duty paid excess of actual amount erroneously. Now, for a moment, I'll come to scenario number 1. First, I'll explain scenario 1, then we'll come to scenario number 2. Customs duty is paid at the rate of 12%, say for rupees 80,000 on 10th January 22. 10th January 22. These goods were sold on 15th January 2022 after use in production. Say importer is Mr. X. Mr. Y, the goods were sold for say 2,50,000. 2,50,000. On 30th January 2022, government, by way of a notification, amended the mistake of rate of duty from 12% to 8%. 12% to 8%. So this is applicable for all the goods which are paid subjected to duty from January 2022. January 2022. Now, on 30th January 2022, the question comes here. Instead of 80,000, say actual paid is rupees 80,000. Now, payable as per the amended rate notification is say rupees 62,000. Just arbitrarily, I'm taking these rates now. So here, when this notification has come into picture, the gap of rupees 18,000, can this be claimed as a refund by Mr. X or Mr. Y? Is a point which is being discussed. X is a person who has imported the goods used in manufacture. X made a valuation, sold those goods for rupees 2.5 lakh. Y got the possession of the goods the day when the notification was amended from 18%, from 12% to 8%. So here, incidence of tax, I call incidence of tax burden. Incidence of tax burden. So students, what happened here? Mr. X has paid rupees 80,000. He has factored this 80,000 into his costing, and that particular commodity or goods was sold to Mr. Y for 2.5 lakh. Was this tax burden on Mr. X? Answer is no. Was this 80,000, that is 18,000, is this a burden on Mr. X? Answer is no. Sir, X didn't pay the burden. Then whose burden is this? It is a burden of Mr. Y. So, a refund, when we examine, they say the person who paid the tax or the person who has borne the incidence of tax only can claim refund. Only can claim refund. Now, technically, Y cannot approach the customs authority because bill of entry is not in the name of Y, it is in the name of X. But on the day when this rate notification has come, X has already paid that 80,000 and passed on the burden to Mr. Y. For that reason, this 18,000, they'll say, instance of tax burden is not passed on. It is not kept with X, but it is passed on to Mr. Y. Scenario number 2. Duty has paid excess than actuals. So, in this case, say, as per bill of entry, the duty to be paid is rupees 85,000. But actual payment by erroneous thing, it was paid for rupees 1,25,000. Now, what happens here? You as an accountant, you will park this 40,000 in your balance sheet as current asset. You will park this money of 40,000 as tax paid excess. So when you make the remittance, what you will do? Debit my advance customs duty, credit my cash or bank account. When I debited my customs duty for 1,25,000, when the bill of entry is filed, what I will do? I'll debit my purchase cost 85,000. I'll credit my, look at the accounting entry. I'll debit my advance tax. I'll credit my bank. This is my entry number 1. Entry number 2. This entry is made for 1,25,000. Entry number 2. When I get my bill of entry, debit my purchase, credit my advance tax, advance duty, whatever it is, 85,000. Now, in this advance tax account, by default, there's a money parked for rupees 40,000. Where did I park this money in this advance tax? I parked in my balance sheet as current asset. Now, examine the burden. This burden I call as incidence of tax. Incidence of tax. Did I pass on this incidence to my customer? Was this passed on to my customer? Answer is no. Sir, whatever tax, whatever duty I have paid, I have parked in my balance sheet as money which was burned by me. That point in time, if I file a refund application under section 27, look at the language. They say the person who paid the tax or the person who has burned the incidence of tax shall claim a refund. I was the person who paid the tax. I was the person who was borne the instance. Then I will be the person entitled to file my refund application. This is the starting point, students. If you know this technical point, the entire discussion, the general principle of unjust enrichment is pretty easy for me to explain. Let me see if there are any questions so far. Great. So, noted, Viraj. Balaji is asking this question. Sir, this unjust enrichment, is it there under GST law? Answer, yes. This concept of unjust enrichment. Alternatively, we also call as incidence of tax. This principle exists even under GST, sales tax, VAT, central excise, service tax, even under now customs. So answer, yes, Balaji. This when we read section 54, subsection 8, section 54, subsection 8 of GST Act, this deals with the concept called burden of proof. By the way, one very good point. Thanks, Balaji, for asking this question. There's one basic assumption. There's one basic assumption. In any of these tax laws, it is deemed to be, it is a deeming provision. What is a deeming provision? They say, unless proved, the incidence of tax has been passed on. So it is a presumption by the tax officer. Unless you prove that you have not passed on the burden, it is deemed that you have passed on the burden to your customer. So if you prove contrary, then you can claim a refund under this law. Hope this is clear, Balaji. Let me see any other questions. Great. So far, so good. Coming back. So the provision says that if you want to claim a refund, it can be made by a person who paid the tax or a person who has borne, spelling mistake, who has borne instance of such duty or interest. So where do I find this instance? Now, the burden of proof is on the applicant, that is assessee. So how do I prove this? I have to show them. So please look at my cost sheet. My cost before payment, my cost after payment. Now I have to prove them that, sir, I have imported the material. Before paying the duty, this is the cost. After paying the duty, this is the cost. And if at all, if I feel that I have paid excess tax, this excess payment, I have parked in my balance sheet. This is what I have to prove to the satisfaction of the officer concerned. Then moving further, claim by the importer or exporter for refund of duty. Interest must be made before expiry of 1 year from the date of such duty. So as per refund, my time limit is 1 year. For duty drawback, my time limit is 2 years. In case of refund, my time limit is only 1 year. Examination, this will be tested for 1 MCQ question. 1 mark MCQ question. The time limit for duty drawback, 1 year. The time limit for refund, 2 years. True or false? It is ulta. Time limit for duty drawback is 2 years. My time limit to file a refund under section 27 is 1 year. Moving further, claim by another person from whom duty was collected must be made before expiry of 1 year. No limit of payment of duty under protest. Now, I don't have any time limit when I make the duty under protest. What do you mean by under protest? When there is a dispute. When there is a dispute. For example, say anti-dumping duty. We have seen two sessions before, the goods which are of steel ingots which are imported from China, these steel consumables are subjected to anti-dumping duty. The importer says, for a moment, when we talk about steel, or let me take example of a glass. Say, Saint Gobain has imported a glass from Saint Gobain, US. The government of India has levied anti-dumping duty. Now, this Saint Gobain has filed an application saying that, no, there was no dumping which is being happening to India. This was a regular practice. This Saint Gobain India has got a contract from Indian government for 10 different projects. This caused increase in the supply. Alternatively, this Saint Gobain India, they have imports being done from China because of a policy decision in China. The production or plant in China was closed completely, because of which the alternative supply is happening from US. So when you have evidences to prove, but the government feels that this is subjected to anti-dumping duty, that's a point in time the dispute arises. So what you will do as an importer, you will pay anti-dumping duty, but you will write a letter to the concerned jurisdictional officer saying that I disagree for this anti-dumping duty and I make a payment under protest. When I make a payment under protest, adjudication starts. So what happens? First, a show cause notice will be given. Then it gets converted as an order. Then I go for an appeal. Then this is called order in original. When I file an appeal, it gets converted as order in appeal. From here, I go to a tribunal. Tribunal also matter will be against me. From me, I'll go to a high court. Maybe I'll go to Supreme Court. So once the matter attains finality, and if I get a final verdict in my favor, then they say under protest, there is no time limit. There is no time limit. So wherever you have a dispute, please think of making a payment under protest. Question comes here. So this payment under protest, can I make a payment under GST law? Answer, you can make under any taxing statutes, maybe income tax, maybe indirect tax. You just write a letter to the concerned authority saying that, look, I made a deposit of this tax, but I deposit it under protest. I'll give an example of GST law. This bundle technologies, you might have heard this entity called Swiggy. The GST department, anti-evasion, when they were conducting audit, they came to know that Swiggy has taken an input tax credit to the extent of some crores of rupees, which was not appearing in GST at 2A. So there was a process of summons issued under Section 70 and all, where the directors and operational people were called for investigation. This authority, what they have done, they paid the duty, whatever tax was demanded, using Form DRC-03. After making the payment, this company has filed a writ petition in the Karnataka High Court. So Karnataka High Court said, this officers have caused undue influence by way of summons under Section 70. Because of that pressure, the management has paid the duty, the tax under protest. Because they have paid under protest, that amount is subject to refund to the concerned company. So what this company have done, they filed a writ petition saying that this DRC3 payment, what they have paid, though it was made under Section 73, it was under protest. By way of a written letter, they wrote a letter to the jurisdiction office. Based on the rejection, a writ petition was filed, and the government has directed the authority concerned to refund that particular amount. This is the power of making the payment of duty under protest. Even I can use it for GST also. Also, they say if your duty is less than rupees 100, you'll not get a refund. Now, we are at 8:40. I'll take maximum 5 minutes on this slide. This is the crux of entire theory for 4 marks. As I said, mutual exclusive. Theory question for 4 marks could be tested on unjust enrichment. So here, the concept is that my refund whatever I seek should be having a documentary evidence. So whenever I file an application, I have to give a documentary evidence. For what? For payment of tax. Then I have to establish that this amount of customs duty or amount of interest in relation to which my application for refund is filed. It was collected from or paid by him. That means to say, the authority, the proper officer, have collected the customs duty or it was paid by him directly. And the incidence of such duty or interest. When I say incidence, I call this as burden. Has not been passed on by him to another person. This is a theory called unjust enrichment. So here, how do I prove that this burden has not been passed on to this particular customer? I'll give one provision and anti-provisions, anti-profiteering under GST law. Let me give this example. Say, on 30th June 2017, the rate of customs duty is 18%. On 15th July 2017, my rate of customs duty was reduced to 12%, keeping in line the GST provisions. Now, I'm just explaining the concept of anti-profiteering, which is also connected with my refund-related provisions. So here, my selling price, my MRP or selling price is fixed on the basis of customs duty. Now, let's take this pattern: purchase, duty, payment, or I'll make it here: duty payment, landed cost, markup, selling price. Now, so this is called as scenario 1. This is called scenario 2. Now, scenario 1, scenario 2. Say, I have purchased a commodity for 10,000. My duty payment happened at the rate of 18%. In the second case, instead of 18%, it is 12%. Landed cost happens to be 11,800, 11,200. Now, here, I would say selling price MRP. My markup is, say, 20%. My markup is 20%. Even in scenario 2, 20%. Assuming, keeping a markup of 20%, this into 1.2 happens to be my selling price. Now, assuming even after change, I keep my selling price as 14,160. What I have done, though customs duty has changed, I, as a seller, I never changed my MRP prior to changing the customs duty. After changing the customs duty, what happened? I've kept my MRP at the same price. In second scenario, actually on 11,200, if I have to keep margin of 1.2, I get my selling price as 13,440. My seller has made a anti-profit ring. So here, my seller has made a profit of 720 rupees on account of reduction in customs duty. So here, the burden of tax should have been passed on to my customer. This is connected with my GST provisions. Coming back to customs provisions. Now, this is a case where the seller is enjoying the benefit of decrease in customs duty. Alternatively. Now here, a reduction in customs duty burden should be borne by the seller. So the law says that whenever you are claiming a refund, please prove that you as a seller, you borne the burden. Now, where do I get across, where do I come across these kind of situations? One, classification issue. Two, levy of anti-dumping duty, safeguard duty, or protective duty, litigation. Third, erroneous assessment. Now, classification. Probably I've classified goods under 8502 instead of classifying as 8507. Because I classified as 8507, I paid the regular duty of say 18%. 8502, 8507. This is my original classification. This is my wrong classification. Rate of duty, ordinarily I have to pay 12%. Erroneously, I paid 18%. Now, when I release this, I should have, the moment I paid this, I have realized that I paid duty excess. So what I will do, I should not have take this in my pricing. So when I have a selling price, I should not costing pricing should not factor 18% duty. So all of you know accounting standard 2, when we do inventory valuation, what is the cost of goods? So I should not load that 18%. I should have only captured 12%. The balance 6% what I have paid, I should park in my balance sheet as incident not passed on. So when the officer asks you a question, what is your value? Have you done the valuation at 12%? Have you done the valuation at 18%? So we have to prove to the officer that, my dear officer, I paid 18%. Look at my cost sheet. When you look at my prime cost, I loaded 12% to the raw material. Balance 6% I have marked in my balance sheet. This is one example of classification. Moving on, litigation. So I have paid my anti-dumping duty, which I don't want to pay, which I am not in agreement with the departmental officer. That could be a scenario where I claim my, I'll not pass on the instance. I'll park it as my litigation in my balance sheet. Erroneous payment, I've given an example. Instead of paying 10,000, I paid 90,000. Moving on further. Now, the application which was filed, if it is complete in all aspects, and where the money is due for refund, it will be the money will be refunded to the applicant. There could be cases where this money may be instead of giving to the applicant, it will be credited to consumer welfare fund. Where when this concept of unjust enrichment is established. This concept of unjust enrichment is established where proper officer is not satisfied that whoever has filed the application, they have not proved to the satisfaction of the proper officer that you have complied with the concept of unjust enrichment. That means you transferred the burden. You have transferred the burden to the customer. So in those cases, they'll say, okay, I'll give you a refund and it will be credited to Consumer Welfare Fund. A classic example. I'll give a classic example. Say you have collected, now all of you are aware, Residential Welfare Association. In case of Residential Welfare Association, up to rupees 7,500, there's no need to pay GST. For a moment, though I have been collecting 6K as Residential Welfare Association maintenance charges, I collected 18% GST. And this money was paid to the government. After making the payment, you realize that you ought to not to be collected, but you collected and paid. They say this concept of unjust enrichment is not established because you collected that money from customer. Because you have passed on that burden, it will be credited to Consumer Welfare Fund. Then moving, instead of giving a credit to Consumer Welfare Fund, now examination, this is one theory question you can expect as a 3 marks question in your examination. The previous slide, what I've explained to you, this is a case where money is getting credited to Consumer Welfare Fund. Now, this is one question, 3 marks theory you can expect where explain the circumstances where refund will be given without examining the provisions of your, instead of giving a credit to Consumer Welfare Fund. So they have given conditions where the money will be not questioned. So first, if the burden is not passed on, straight away the money instead of Consumer Welfare Fund, it comes to the applicant. Second, imports were made by an individual for personal use. Like example, say Mansa has imported a laptop where she paid 50,000 as customs duty. When she is sending back this laptop, there is a question of unjust enrichment. She is the person who paid the customs duty. On filing an application, she should have got that money as a refund. Third, the buyer who has borne the duty and he has not passed on the instance. Here, importer or exporter. In the other case, the buyer. The person who paid directly on behalf of the importer or exporter, he can also file a refund application. That means the person who actually paid. Point number 4. If the refund is in relation to export of duty paid goods. Now, export of duty paid goods, generally, exporter is a person who can claim a refund. I'll give an example of refund under Rule 26, Section 26 for exports. Exports, it is a little tricky provision. I have paid export duty where the goods are returned by customer. This is not coming back as a resale, not as a resale. That means customer has purchased the goods, has sent back to me, and these goods are re-imported within 1 year. And this exporter has filed an application within 6 months from the date the proper officer made an order for order for clearance of those materials from domestic area. Now, these are the circumstances where the exporter can file a refund application under Section 26. Now, precisely, I would call this as a sales rejection. Sales rejection. Goods were exported. Say, I have exported goods to Nepal or Bhutan. On exporting the goods to Nepal or Bhutan, the customer says, Praveen, you did a consignment, wrong shipment. I asked for 10 inches nut and bolt. You have supplied 8 inches nut and bolt. So entire consignment has come back, not as a resale. And this has come back within 1 year from the date of export. Then I can file a refund application under 26 to claim a refund. And here, concept of unjust enrichment is not required. Unjust enrichment is not required because I can export goods, not the duties or taxes per se. Even if I have shown the respective duty, customer will not pay the customs duty. I, as an exporter, I have to pay that particular customs duty. Next, under duty drawback, provisions of duty drawback, I need not show this concept of unjust enrichment. Then, the central government, by way of a notification, they may identify some applicants who can file, who are notified, list of people who have been notified by filing this application. Last but not the least, there was excess payment of tax, which is evident from the bill of entry. And after the reassessment, this amount can be claimed, given back as a refund. Now, excess payment, 10,000 is a duty payable. 10,000 is a duty payable. By mistake, I have paid 1 lakh as a duty deposit. The balance 90,000, it's clear from bill of entry. My bill of entry shows 10,000 as a duty payable. But TR6 challan has already been credited for 1 lakh. So that 90,000 which was credited to electronic cash ledger can be claimed as a refund from the authority concerned. Let me see if there are any doubts. So far, so good. A refund of export duty. This I have explained to you. Whatever duty I have paid on imports, it will be refunded to the person, that is the person who files an application. If the goods are defective, not as per specifications. So here what happens at the port or at the customs station, I reject the material. I say that, sir, these goods are not to my satisfaction. I wanted to send back these goods. Now, if the goods are not as per my specifications, I return back. So from the customs port itself, the goods are going back. So whatever cash I have deposited in electronic credit ledger towards the assessment of duty, I can claim as a refund. Then, goods are identified as imported goods to the satisfaction of ACDC, where I was talking about duty drawback. Point number 3, no drawback is claimed. Now, when refund comes, now please understand, application either can be filed either for duty drawback or a refund, but both I cannot file. Both not permissible. The procedure, the form is completely different for duty drawback, for refund. Time limit for duty drawback is 2 years. Time limit for refund is 1 year. So please ensure that either I'll claim a refund or I'll claim a duty drawback. Last but not least, you remember this movie called Badmash Company? Badmash Company, where this importer who happens to be the leading actor called Shahid Kapoor, he imports the shoes from overseas. So what does the exporter do? He sends a consignment of left leg shoes. So this fellow, he goes for Customs clearance said this was a nonsense. I ordered for a pair of shoes. He has sent only one pair. So he relinquishes his title. The moment he relinquishes, these goods go for a public auction. Public auction. He purchases initially one pair of shoes. Again, after some time, one more consignment comes. That point in time, this consignment is for one more leg shoes. Again, he rejects that consignment. Again, it goes for public auction. Again, his friend purchases that particular shoe. So he gets these customs duty paid documents, shoes into his shop, assembles that and sells as a pair of shoes at a better price than the market price. So these are the provisions connected with my refund under customs law. Let me see if there are any questions so far. So far, so good. Students, I would advise take it. This chapter, definitely there's a question for 3 marks as a theory question, 1 mark as a MCQ. Just recollect this table where duty drawback, goods exported after usage. That is one particular question you may expect. In case of refund, pretty clear where concept of unjust enrichment will be tested in your examination. Yeah. So we're going to have our last session on 30th of this month, that is on Thursday, where we will discuss on in detail the advantages and benefits available under foreign trade policy. So students, till then, good night, goodbye, see you all.